Welcome to More Financial Talk. I'm Ryan Moore, and with me today is co-host Tony Shore. How are you today, Tony?
Oh, Ryan, I'm excited. I don't know if you can tell. I don't know if our viewers are watching this on video or hearing it. I am excited today because you got a huge get for the show today, a very special guest. So I'm excited for you to introduce her. But first, I am great, been busy, but not nearly as busy as you have been, Ryan. You always seem to have so much going on. How's everything going there?
Good. You are always good at pointing out how busy I am as I
You
try to keep
are.
my head above water. But yes, we're living busy lives, both my wife and I, trying to keep
Yeah.
up with 4 kids and running a business and all the things. So, but we're
Yeah.
chugging along and feeling great. So all is well.
Wow, four kids. I have three, and I thought that was one too many because you have to, when you go from 2 to 3, you have to switch from that man-on-man defense to a zone defense, and so,
Well
right,
put. Yes,
you're
yes.
outnumbered.
You cover
Well,
more
hey,
ground.
yeah, let's get to the big news of the show today, Ryan. You've got a very special guest. Introduce this guest for our listeners out there.
Yeah, so we'd like to welcome Becky Swansburg, CEO of Stonewood Financial out of Louisville, Kentucky. And been working with Becky and her group for a number of years now. And we just couldn't be more grateful for the resources and the support that they provide for the category of what we do as it relates to tax planning, which is a very big niche focus of our firm, as you know, Tony. So we'd like to welcome on Becky, who's going to be a wealth of information for us today. So welcome aboard here, Becky.
Thanks so much for having me. I've got twins of my own, so we're still man to man, just two.
There you go.
There you go.
Right on. Well, excited to have you here. And, the topic today is really going to be, picking your brain a little bit about the big tax bill that recently got passed through legislation and ultimately what some of the key takeaways are. But before we jump into that, Becky, I just was, hopeful that you could share a little bit about your background, because I know that you operated in politics in D.C. and were instrumental in working with congressmen and women on tax law reform. And just was, thinking that you could share a little bit about that background and, how that part of your career went and got you there. And, we'll go from there.
Yeah, well, like every bright-eyed young idealist, I decided I needed to go to the nation's capital and make a change. So I spent most of my early career in Washington, D.C. I worked in the White House under George W. Bush during his first term, and then over on Capitol Hill for the Speaker of the House and a couple different members of Congress.
Wow.
And it's funny, I originally went to Washington so eager to impact policy. But the thing that I really took away is that every year, Congress is passing all of this new policy and legislation, and most Americans just have no idea what it means for them. And of course, in our space specifically, what it means for people's retirement approach. And as I watched my parents kind of be impacted by these different tax laws and legislative changes that were constantly being passed in the Capitol, it occurred to me that we almost needed a translator. Sometimes we need someone to kind of look at what's happening in Washington and figure out what that means for people like my parents who are saving for retirement. And I know that's what we're all here to do, is help translate that Washington talk into what it actually means for our listeners.
Excellent. Well, so then you gravitated back to the private sector. And as you're currently in the role of CEO for Stonewood Financial, and maybe you could share what the primary focus of your company is and how you were led to that from the world of politics.
Yeah. So the company Stonewood really exists to help savers and the advisors that serve them make that connection, understand what's happening in tax policy and economic policy in Washington, and then how do we need to make adjustments or shifts in our retirement approach to maximize or kind of leverage what's happening in Washington, of course, minimize those taxes in retirement. Nobody likes paying more tax than they need to. So that became a passion of mine, was really helping savers through analysis understand tax risk. I truly believe taxes are one of the largest, least understood risks that face American savers today, but they can be a hard risk to identify, quantify, and then address. So that's really what Stonewood is here to do. And I know that's how we work together, is just helping clients identify this risk, put a dollar amount to it, and then see if there are adjustments that need to be made so they don't end up spending more taxes in retirement than they need.
Excellent. Now, I know you work a lot hand in hand with a lot of existing, financial advisors that have this focus. And what we appreciate about the relationship is the resources and tools that you make available to ultimately convey to the end, focus, which is the client, like you said, and the tagline of our show here is to keep more in your wallet, right? And so ideally that's what this is all about. And I think we're all willing to pay our fair share, but ultimately, we want to keep more of our hard-earned money to utilize in the manner that we choose. So that leads us to, the big takeaway here from the big beautiful bill, as they called it. And I'm just curious, what the key takeaways are in your mind, ultimately how this played out.
Yeah, it's been a big summer while we were all enjoying hot dogs and America on 4th of July. The president signed into law this big, beautiful bill, which is probably the largest single piece of tax legislation since the 2017 Tax Cuts and Jobs Act. So lots of stuff packed in this bill. For our listeners, the three pieces that are probably going to impact them most. One is that the bill made permanent, and we'll talk about what permanent means and why. If you can't see me, I'm putting some air quotes around that word permanent.
Yeah, that's right.
But for the foreseeable future, we have extended the lower tax bracket rates that were originally passed as part of the Trump tax cuts or the Tax Cuts and Jobs Act back in 2017. So today's individual income tax bracket rates are actually for middle-class America about 30% lower than they were pre-reform. Those lower rates were actually set to expire in December. So this legislation for the foreseeable future has kept those lower rates in place. Great news. Number two, they also made some of the estate tax exemptions permanent, again, permanent with quotation marks, but have extended them into the foreseeable future. So those higher estate tax exemptions are now in place for listeners that have kind of, businesses, farms, or just large estates to pass. And the third, and perhaps the one that I get the most questions about, is this new deduction for Americans age 65 plus that's intended to offset some of the taxation of their Social Security benefit. So I know we'll probably get deep into the weeds on each of those, but really we come out of this bill with a lower tax bracket rate environment maintained for the foreseeable future, with the ability to pass more wealth to the next generation under those estate tax exemptions, and with a new deduction for seniors age 65 plus that'll last for the next 4 years so that they can deduct a little more when they file their taxes.
Excellent. And so before we drill down on some of that, just curious, was the outcome what you expected, or were there some surprises to you regarding?
That's a great question. If you had asked me a year ago, 18 months ago, did I think that we would kind of get this extension of the Trump tax cuts? I would have said it's shaky. We had to have President Trump elected for a second term. We'd have to have Republican control of the House and the Senate. Now, we managed to come out of last November with all those things in place. So once we got into this new year and the president made such a pressing priority the extension of the Trump tax cuts from 2017, I knew they'd find a way to get something across the finish line. But I do think that resulting package from a tax lens is very beneficial for U.S. savers, particularly for savers that have maybe done a good job saving and plan to have higher levels of wealth in retirement.
Right. And, from our perspective, ultimately, we were hopeful that the tax codes would get extended because it does give people a longer runway to kind of address the manner in which they've been saving most of their working years, which, we've talked plenty, Tony, in the past on some of our podcasts, what I call the great misconception, which is we were led to believe the best way to save is in these deferred buckets and we'll be in a lower tax bracket when we retire. And that's ultimately not how it's playing out for many. And so with strategic approach, you can, ultimately go from the forever tax bucket to the never tax bucket Obviously, you have to pay taxes. That's inevitable to certain things in life, but there are strategic ways to ultimately transform one's retirement and potentially even be as low as in the 0% tax bracket in retirement. So that's a big focus of our company. Now, one thing that always blows me away a little bit is, and you kind of hit on this, which is, you have so many advisors out there that don't focus on this. I believe only about 25% of financial advisors do any real type of tax planning when it comes to investing, but yet everybody's a fiduciary, and here's my air quotes. Okay. But it is the biggest tax or the biggest bill or expense that we face in our lifetime. So why isn't it a greater focus? So I really looked at this as an opportunity for our firm to develop a niche and a focus that does separate ourselves from those that don't want to dig in this category. And I think we're appreciated for that. And that's where the tools that you provide come in to ultimately help convey this message. So
that's a great point. The work you do is so important because I will guarantee you every listener today does not care most about the size of the check that's coming out of their 401k or out of their IRA. They don't really care about their withdrawal amount. They care about the amount that gets deposited into their bank account for them to go spend in retirement. And you know what's the difference maker between those two, between what comes out of your IRA and what you actually get to spend in retirement? That's taxes. So if we're not planning for taxes in retirement, we are leaving up to risk and chance how much money actually ends up in our bank account so that we can go spend it on the retirement we want.
Right, because you have a partner in these deferred accounts. It's the worst partner you could have because you have zero say in it, and that's where legislative risk comes in. So ultimately, it's about settling up with your partner while taxes are on sale. So let me just ask you this. Do you think we'll ever see taxes lower than where they are today?
I would be hard pressed. I believe that at least in our lifetimes, this is probably the lowest tax bracket rate environment that we are going to experience. One is because, as I mentioned, for middle-class America right now, tax bracket rates for single filers are about 30% lower than they were back in the early 2000s and late 1990s. So we are actually about 30% lower than kind of historical norms in recent history. There is really nowhere to go but up for taxes. So the real question is, will taxes need to rise? And the question that drives that is, will the government need more money in the future than it has today? And I say that almost in jest because who listening feels that the government has all the money it currently ever needs and will never need anything else? So I think when I look at coming off one big, beautiful bill, what I think is most exciting is that it has given us a runway to leverage the low tax bracket rate of today to prepare for higher taxes that I believe are coming 10 or maybe 20, 30 years down the road for sure. And I want to remind listeners, retirement is not about the next 4 years. Retirement is not just between now and the next election. Our retirements are going to last 10, 20, 30, 40, even 50 years into the future. And there's no way that taxes are staying this low over that time frame.
Right.
Yeah, I totally agree with you there. Now, as you know, I work with another authority in the industry on this topic, David McKnight, and he's the
Very
author
smart.
of the renowned book, The Power of Zero, and basically how to transform your retirement to a 0% tax bracket. And I was trained by him and by you too, ultimately. So when we got David's take on the results of the bill, what he said was he's calling it the permanent temporary tax extension. And you had kind of touched on that earlier. What he was indicating there is the debt to GDP in 10 years from now could be 140%, and the debt could be 60 to 63 trillion. He also quoted Wharton School of Finance that said by 2040, the debt to GDP could be 200%, calling it a debt death spiral and financial collapse. And so when we say it's been put into permanent law, maybe you can speak to that a little bit and why we air quote, the actual permanency of something like this.
That's exactly right. So when we say permanent in my life, when I say, oh, that's a permanent decision, permanent means forever. And when our government says permanent, as in a permanent extension of these lower tax bracket rates, what they mean is until Congress changes its mind. So permanent for the government just means these lower tax bracket rates will not automatically revert to the older higher rates in the future. It will take Congress passing another piece of legislation. But Congress passes hundreds of bills of legislation every single year. So when I look historically at low tax bracket rates environments, going all the way back to maybe the Kennedy tax cuts in the 1960s, those low bracket rates tend to last between about 8 to 12 years at the most before Congress comes in, needs more revenue, and raises the brackets back up. So I do think we have some planning time available to us before rates will start to drift up again, but they're not staying low for long.
Yeah, I mean, when you look at the fiscal condition of our country and just the debt alone, the writing is pretty clear on the wall, that we're struggling in that regard. And so ultimately, if I have a group of 100 people and I say how many people think taxes are going up, I'm going to get 99 hands that are going to be raised. There's always that one in the group, right? That being said,
I'd love to have that optimism in my heart.
Oh, yeah.
Right. Well, I do think the message then, ultimately, the takeaway that I get from you and also Mr. McKnight is that there is about a 9 to 10 year window here to take advantage of these historically low rates and how to confront proactively how to address the taxes that might, ultimately be built into your retirement nest egg. And that's a big part of, having a strategy to address it.
Yeah. And when we are thinking about what is the likelihood of taxes rising in the future, there are really three key indicators that I look at that for me and for many experts indicate a rising tax environment that we could be entering into. And all three of those indicators right now point to, yes, we are entering a rising tax environment. So those indicators, number one, I look at current year deficits. Are we currently paying for the amount of government we have? And as you know, this past fiscal year, our government ran about a $1.88 trillion annual deficit. That's not unique to 2024. We've been running between $1 and maybe $2 trillion of deficits for multiple years now. So we're not even currently paying for the amount of government we have today. Then I look at number two, demographics. Where are we trending as a nation? Well, as a nation, we are rapidly aging. We currently have more seniors age 65 plus than at any time in US history in the last 100 years. So we know that things like Social Security, things like Medicare are not just going to be at their unsustainable rate today, but that problem is going to get worse into the future. We're going to need even more revenue, not because of Republicans or Democrats being in Washington, but simply because of the American people and our demographics. So that's number two. The third indicator I'm always watching is kind of our debts that we owe that at some point we're going to have to pay. As many listeners know, our current federal debt sits above $36 trillion with a T, trillion dollars, the highest it has ever been in history. And what's on top of that, we talked about demographics. Over the next 75 years, so through the rest of this century, there's about another $76 trillion of unfunded Medicare and Social Security benefits that we currently have no way to pay for. So we can't pay for the government we have today, and the problem is only going to get worse, and the debt is growing rapidly. All indicators are showing taxes are going to have to rise to avoid fiscal ruin, as Mr. McKnight mentioned.
Yeah.
We don't want that death spiral.
Right. And I think part of what you're referring to there are the unfunded liabilities, right? Which essentially is a future promise to pay. And that's not even necessarily factored into the current debt number. So, which leads me to believe the situation's maybe even a little bit more dire than how it's being presented. Right. So let's shift gears here a little bit and get back to, one of the takeaways, which was the Social Security effect as it relates to the bill. And I think one of the campaign promises was to eliminate taxation on Social Security. And it didn't quite play out that way, but let's try to unpack, what was impacted in that particular category.
Yeah, so that's the number one question I'm really hearing from people on One Big Beautiful Bill is like, oh, hey, President Trump said I don't pay taxes on my Social Security benefit anymore. Is that true? And the answer is a little more complex because everything in Washington is a little bit complex. So the goal, one of Trump's campaign promises is that seniors should not pay taxes on their Social Security benefit. For our listeners, when Social Security was first introduced, the benefits were not taxable. In the 1980s, they became taxable up to 50% of your benefits under Reagan. And then under Clinton in the 90s, another law was passed making them taxable up to their current 85% of the benefit. So another important thing to know about the taxation of Social Security benefits is that unlike your income taxes, which go into the general IRS kind of bucket to go pay for priorities for the government.
Where things disappear.
That's right. Just in that magic
where that
bucket
money
where the
can
money
just
lives.
poof.
That's right. Social Security, the taxes you pay under Social Security benefit are actually earmarked for the Social Security and Medicare trust funds. Because of that, when the House and Senate went to pass the One Big Beautiful Bill, if you remember, we have very tight Republican control of the Senate by very few votes. And so they needed to pass it under something called reconciliation. And reconciliation is just a way that the Senate can pass certain kinds of legislation without that 60-vote supermajority. You just need 51 votes. So they knew the only way One Big Beautiful Bill could pass was under reconciliation. Under reconciliation, they could not eliminate the taxation of Social Security benefits because it would negatively impact the trust fund. So what did they do? Well, they didn't give up. They just had to get a little bit creative. So here's what Congress actually did in the bill. They said, okay, for Americans age 65 plus, we will have a new tax deduction. And the purpose of this new tax deduction is to offset some of the taxes that you're going to end up paying on your Social Security benefit. So while it doesn't eliminate those, it was pegged to an amount that was intended to offset those taxes. So right now, that new deduction, which by the way, is available to any American age 65 plus, whether or not you have elected Social Security. So you don't have to have elected Social Security to take this new deduction. It is $6,000 for each individual. So up to $12,000 for a couple. And that's good up to about $75,000 of income for an individual, $150,000 for a couple. After that, the deduction kind of gradually gets less and less until it completely phases out at about $175,000 for individual, $250,000 for couples. So a lot of our listeners, if you as a couple are making less than or having less than $250,000 of income each year, you can now take this new deduction, at least part of that deduction. Now, this one, they didn't even pretend was permanent. They didn't even put it in quotation marks.
Yeah, right.
It is only good for the next 4 years. So we have the 2025, 26, 27, and 28 tax years, and then it's gone. But that does mean for Americans age 65 plus, they have this new tax deduction for the next 4 years that as long as you turn 65 during that tax year, you can take this deduction. So it's a big benefit for seniors, and we can do whatever we want. Mental math, let it offset your Social Security benefit taxation. A dollar's a dollar that gets to go back in your pocket.
Yeah, net to the pocket is right. So very interesting. And I guess we'll have to wait and see what happens in 2028. And I'm sure that will be a big topic in the news.
Yeah, we'll see if they get an extension or if it just expires. But I will say, I think one of the biggest impacts of this One Big Beautiful Bill is that it has a lot of really exciting tax positives for many savers and many of our listeners, but it also adds a lot of complexity to our tax code. And this is why I think we're kind of entering this era where to really appropriately manage your taxes in retirement, you got to be working with a financial professional that understands all of this nuance and how we balance offsetting and reducing future taxes with not risking any of the deductions in today's low tax rate environment currently.
Yeah, it is a lot to keep up with, even if it's what you do for a living, right? And that being said, I do think, our clients greatly appreciate that we do keep up with it for them and give them proper guidance. But, again, as I've said in the past, we don't operate on blind faith. So we want to educate people on how to approach this, how to consider, addressing this taxation proactively. and we have tools to do that. And thankfully to you guys, you give us a great tool, and I want to talk about that real quick. So years ago, you created what's called the total tax burden analysis. And so with that, maybe you can explain what the goal of that was. You'll probably articulate it better than I. So please share how that tool works.
Yeah. So, a few years ago, we came to realize trillions and trillions of US dollars are all in tax deferred savings, as you mentioned, because of this kind of myth that future taxes will automatically be lower in retirement than they are today. And we realized part of the reason that people were kind of blindly buying into this narrative is because it is very easy to calculate the benefit of deferring your taxes. If I put money in an IRA or 401k, and I have IRA and 401k money, when I put money into those kinds of tax deferred accounts, I get that deduction in the year I'm contributing that money. And I can see, hey, I didn't have to pay $6,000 of taxes this year. The challenge is, no one was quantifying for US savers the cost of that decision. What might my retirement tax bill now be in the future because of the decisions I'm making today? What is the cost of that tax deferral in terms of the additional taxes I may be building up in retirement? And so we created total tax burden to analyze that, to say, based on some assumptions we'll make together, and Ryan, I know you do this with your clients day in, day out, let's model out what kind of taxes you might be projecting to pay in retirement in your current approach. And then if we made some adjustments, could we find some significant tax savings and reduce that retirement tax bill?
Yeah, so it's an amazing tool that's really not hard to navigate at all. And we've, piggybacked your resources and created a landing page. And so for our listeners, you could go to rsgtaxplan.com, and it will lead you ultimately to, what am I trying to say here? One of the icons that you can click on that says, could your tax bill in retirement be too big? And when you click on that, it takes you to the total tax burden analysis, report that can be generated by plugging in particular information. So you're putting in your estimated deferred amount of money in the IRAs and 401ks. You're going to put in an estimated, potential growth rate. What kind of fee might you be paying on the investment account? And then ultimately, what kind of tax bracket range are you in, and where are we projecting taxes to go? So there's some assumptions in there, but ultimately, it's a tremendous tool that will give you what will be the life of, or what will be the cost of your taxes over the life of those accounts, and not just in your life, but also passing it on to your beneficiaries. If they inherit pre-tax IRAs, then they've got to ultimately pay the taxes as well. So it's a pretty eye-opening tool, in my opinion, when you can see what the size of the tax bill would be over your lifetime and then passing it on to the next generation, as opposed to confronting the taxes and using strategies like Roth conversions, where you're paying the taxes sooner at a lower tax rate and putting it into an account that can ultimately grow tax-free. And that helps to also quantify, the minimizing of taxes as it relates to converting to Roth and not having to continue to grow the money in the deferred buckets, which ultimately are going to result in more taxes that you'll pay.
Yeah, it's a great point. I always like to say you cannot make informed decisions around taxes in retirement without information. And what I love about total tax burden is, for a lot of savers that I know come to your office, is probably the first time anyone's ever given them the information, the sense of, in real dollars and cents, how much in taxes might I pay in retirement without adjustments? And then if I make some adjustments today and leverage this great low tax bracket rate environment that we've been gifted through one big, beautiful bill.
Yeah, it makes me think of even a recent scenario where I had a higher net worth individual that really came in to just get a Social Security analysis, the timing on when he should turn on his benefits. And, I started to talk a little bit more about the other things that we help people with. And ultimately, he called back, and he one of the questions he asked is, would you be able to calculate what the life of my taxes would look like, and ultimately how I would benefit from Roth? And immediately I thought of this tool, and he said it as a savvy guy, almost thinking that it wasn't something I was going to be able to provide or compute. And I knew right away where to go with the tool. And I'm still dialoguing with the individual and tracking to make a new client. And I think that was a big part of it, because I think we all want a clearer picture of, how much money we're going to end up with, and what impact that taxes are going to have, and where can future legislative risk have additional impact. So all these things are tremendous. I get a little nerdy over this stuff, as I'm sure you do, Becky. Right? That's what makes us good at what we do, I think. So, well, unless you have any parting thoughts, I just want to thank you so much for your time today and taking a moment to share your insights and your expertise. And again, we can't thank you enough for what you're doing overall, but specifically for us and our organization.
Well, I appreciate it. And to use your tagline, one big beautiful bill does give us some good opportunity to keep more in your wallet. So I do think this is a good season that if listeners have not spent some serious time thinking about taxes and retirement, it's worth coming in, having a chat, because it really will be eye-opening. And now is the time to act.
Absolutely.
Yeah.
Well, thank you for that.
And Ryan,
Tony?
why don't you let our listeners know before we go how they can do that, get a hold of you and set up that no charge, no obligation consultation to get a review, get a second opinion on where they're at.
Absolutely. So we can be reached directly via phone at 615-467-6300. You can also check out our website at rsgtn.com, or give us an email at info@rsgtn.com.
All right. Well, great show today. Again, Ryan, a huge get. I mean, Becky Swansburg, thanks so much for being here. I learned a lot today, a lot of great information. And that does it for today's episode of More Financial Talk with our host, Ryan Moore.